Welcome back, everybody, to our weekly mortgage tips for mortgage video series. We're talking about mortgage interest rates today, and it's an interesting time. My name's Mike Parkinson, mortgage broker with Dominion Lending Centers in Campbell River, British Columbia, joined by my cousin Jaden Bax, mortgage broker just outside of Calgary, Alberta. How's your day going today, Jay?
We got dumped with snow. It's one of those where you're shoveling snow every day. It's terrible. If it didn't rain every day, I'd move to the island.
Well, just so you know, it's freaking cold here. We got cold. It was like the wind chill was like minus 10 or 12 last night. And we got a little bit of snow happening right now. It stopped a bit. And it's like wind chill is about minus 10, which is crazy.
Yeah,
That's minus
you know what?
70 there.
Honestly, you can't beat living in Canada, but sometimes you just shake it. Like, look at these interest rates. Look at this snow. Look at
That's
look
it.
at
We're out of here.
inflation. What are we doing here?
No, like seriously, I don't know. We got to rethink this, Jay.
Yeah, exactly.
Well,
Yeah.
speaking of interest rates, what
Yeah.
are your thoughts? We know that inflation's come down, which is great. It's actually came down more than everybody thought, 5.9.
Yeah.
So
Yeah,
it's getting
and
interesting,
significantly
eh?
more. Yeah,
Yeah,
significantly more than everybody thought. And it's interesting, especially following that jobs announcement that we talked about, the
yeah,
150,000
bogus,
jobs
the
and this and that.
bogus.
Exactly.
Yeah,
Absolutely. And so, and that announcement it was incredible, the repercussions through the bond market, right? You could feel the bond pricing went up. We could see it on our end that lenders, their 5-year fixed all went up. The
yeah,
2 and 3 basically stayed the same, but the 5-year fixed all went up by 0.15% for
yeah,
the
a
most
little
part.
bit. Yeah,
Yeah, a little bit, but anyway, it was interesting how, and now this, and because everybody was kind of thinking, okay, well, that job, we thought that they were going to pause rates. Now they'll definitely have to raise rates. Most economists I'm seeing now, 90% chance that they just hold it down to what we have right
they'll
now,
hold.
no
They'll
change.
hold.
Yeah,
I'd be shocked if they
absolutely.
change. Like basically, this data that came out here is they're going to hold. They're going to pause. I honestly, Jay, if unless there's a shocker that could happen. And again, you might see a point where inflation comes down and takes a little dip up again. The data is just so crazy, like how accurate really is it, and things can happen, right? And if we look at the U.S., which is a little bit different, they came in a little higher than what they were expecting, right, at 6.4%. So I think the U.S. is going to raise rates definitely once or twice more. But I think Canada's pretty much done. That's just my opinion. So that's probably why we're seeing bond yields go up, the longer term bond yields go up, because our fixed rates and bond yields basically follow what's happened in the U.S. So I think we're going to see a little bit higher, maybe fixed rates in the short term. What are your thoughts about that?
Yeah, I would tend to agree. I think 2023 is really going to be a leveling out year in the first half year, and I really think it's funny, right? Because we've been talking about this for basically since we started this video series.
Yeah.
We know that interest rates are lagging on their effect on the economy and things like that, and so now all of a sudden they're surprised at how quickly they're going down, and you just think to yourself, well, what did you think you were doing? What impact did you think you were going to have on the economy, right? So, yeah, absolutely, probably slightly higher interest rates on the fixed side, but I also feel like we topped out there when we were at that kind of 5.24, 5.34 on
Yeah.
a high ratio 5-year fix. I
Yeah.
think that's the high end of what you're going to see. So we're not going to push beyond that. I personally would be shocked if we actually hit that amount in Canada. I think what's going to happen, because one of the things that we have to remember is, generally speaking, there's a yield that they have between the bond and their interest rates. That's where their margin is, and that's where they kind of make their money. And because of the uncertainty in the market, most lenders have beefed that margin up a little bit more. And I think your experience, you've got 20 years. I'm just over 5. Just coming up on 6. But generally speaking, somebody's gonna blink, right, in terms of the lenders, and so somebody's gonna bring their rates down and close those margins back to what their traditional numbers are, and when that happens, the rest follow, right? So that's my prediction for 2023. No matter what happens with the bond market, I think we're going to see a little bit of tightening in that margin. What are your thoughts?
Yeah, I agree. I like you and I have pretty much been on par with what we've been thinking this whole time. There are a lot of economists that still think rates are going to stay higher longer, but again, they're economists, and nobody knows what's going to happen, right? And how many times are they actually right? They're just looking at the data, which I get. Is the data 100% accurate? I don't, definitely not, based on the job numbers and stuff. If you really dig into it, again, I don't have a crystal ball either, neither do you, Jay, but I'd be really shocked a year, like if this time next year rates aren't lower than they are now. Again, we have to wait and see. Right now, it looks like everything's doing just fine with the job numbers, inflation starting to come down. So it looks like they're doing their job. But things could really, I guess, fall off a cliff really quickly. And I think the longer they hold rates higher, the faster they're going to fall. Again, that's just me. That's what I firmly believe. The right now, like still right now, the 3 and the 5 year fixed rates, the 7 year fixed rates are much more attractive than shorter term fixed rates. But I still like the strategy of the 1 to 2 year, at least.
Absolutely.
Look at that. So I think people that are, again, just our opinion, and it's up to you in the end, people that are taking a longer term fixed rate, a year or two from now, could be kicking themselves. But
I did a webinar today with a financial planner partner of mine, and we were talking a little bit about some of the if you're downsizing and some of the potential costs of selling your home, and one of the things that people don't think about is the penalty cost. And so just did some quick calculations on a 3 month interest, which is the penalty you'll pay if you have a variable rate mortgage, or if your fixed ends up under certain calculations, versus an interest rate differential, which is generally speaking what you pay on a fixed. And
big difference.
Did it from a big bank perspective. I did it based on the rates of today, and kind of put them against what we would consider more general rates. So I think I used 3.25% for a 5 year fixed, and somewhere around 2.8% on a 5 year variable, 2.5 years in the future. If you had 30 months left on your payment with the numbers that I used there, $300,000 left on your mortgage, and you had to pay the penalty on a variable, you would be looking at about a $2,100 penalty. For that exact same amount owing, exact same amount of months left, you're looking at $25,000, right? It's unbelievable how when you lock in to a high rate environment and then go back to a lower normal rate environment, the potential for penalty is enormous.
Yep, and that's something for people to understand. And again, we just don't know where rates are going to be a year or two from now. We're just kind of following the trend that what goes up comes down, vice versa. And with the debt load in this world, and it just doesn't make financial sense for these rates to be this high. But if you're still comfortable with a 5 year fixed, and you can't sleep at night, and that's going to work for you, you just need to understand that if you're trying to get out in a couple of years because rates are so low, it could be very expensive for you. So whatever you get into, make sure you understand that. So that's the biggest thing. But yeah, I'm on board with you, Jay. I think we're going to see, I think the second half of 2023 is going to become very interesting. I think with the corporate earnings coming out in the first quarter, I think they'll be a lot weaker than what everybody predicted. Look at Walmart and Target came out with some pretty weak numbers here in the US. So we'll see. We'll really see how these employment numbers turn out, and if the economy is as hot as what they think it is. So
yeah, absolutely. And so if you're in the market right now and you're looking at that 5 year fix, you're looking at any of the rates out there and are pulling your hair out because you can't make a decision, you're gonna end up looking a little bit more like Mike Hansen than he is. Yeah, but it's we're happy to chat to you guys about that. So please give me a call if you're out in Alberta or Mike in BC, and if you're anywhere else in Canada. We're pretty tied into the national rate market, so always happy to have a chat. Give us a call at the numbers below, and have a great rest of your day.
Yeah, have a good one. See you later.
Thanks, guys.